So let's just start with today. What are you expecting from the decision, the vote, and from Mark Carney in the press conference?
Well, the decision and the vote are likely to be confirmation things are staying as they are for now. But there's a lot for the bank to reflect on since their last forecast in November. We've had the updated fiscal forecasts. We've had the progress on at least phase one of the Brexit negotiations. There's been plenty of data, including the stronger Q4 GDP print. And, of course, the market moves in January, so there is a lot for the bank to put into perspective today.
Yeah, not least of all market pricing. The markets have been starting to price in a more aggressive rate hiking cycle for 2018. We've got the probability of a hike in May now standing at around 50%. It was higher. Is Mark Carney likely to push back against that?
We don't think so at this point. I think some of that's come from the general move in bond markets around the world. It's sort of dragged UK yields with it to an extent, but we think they'll be reasonably content to see where the market is. There's a lot to happen between now and May, of course, particularly around the Brexit negotiations. So I think to sort of push back too much on market pricing risks kind of closing that door off to them. And if things go well between now and then, we do think there's a good chance they may hike. So I think they'd like to see things stay pretty much where they are, and that's the tone we think will sort of try and support that today.
So a sort of balanced view coming out of the press conference then? Yeah,
exactly. And as I say, there's been a lot of data. It's been a bit mixed in truth. I think the fourth quarter was a bit stronger than they anticipated, it seems. But some of the sort of forward-looking sentiment data, the PMIs, for example, missed to the downside a little bit. So at this point, I think they'll want to be fairly careful, keep the tone balanced and wait to see how things play out.
When it comes to May, you actually say that the Bank of England will hike in May, but you make that explicitly conditional on the UK getting this transition deal from the EU by the end of March.
Yeah.
Tell us a bit about that. Will they hike in May then?
Well, I mean, the bank has said repeatedly that uncertainty is one of the sort of key determinants of where we head from here, certainly in terms of investment decisions being taken, how companies behave over the coming period of time is closely linked to clarity around Brexit. So if we get the transitional deal in March, we think you'll get a sort of pickup in investment, you'll get a sort of improvement in sentiment, and with growth still holding up okay, we think that'll give them the opportunity to hike. That said, we do think there's a lot of risks around this transitional deal. There's still a lot to be decided. We see the sort of domestic political uncertainty as well as the uncertainty in the negotiations themselves. And if things don't come together in March, then the worry will be that companies may start making decisions which ultimately hurt economic growth in the UK, in which case we think the bank will want to keep policy supportive and not to hike in May.
Yeah, it's a different question over whether they will hike in May and whether they should. Do you think they should?
I mean, in our view, we actually don't, and for that matter, we don't really think they should have hiked last November. The data, as I said, is mixed. There's still not enough evidence for us that wage inflation's accelerating, and now, without that, of course, if you raise rates, you raise borrowing costs for consumers, for borrowers, and if wages don't pick up, consumers are going to struggle even more than they already are. And I think if you look at retail sales, if you look at consumer confidence barometers, there's plenty of evidence that consumers are finding life difficult. So to raise borrowing costs is to take a risk with consumption, maybe not now, but certainly over the next year or two as those borrowing costs start to bite. So for us, with all of these uncertainties around Brexit and what's going on in the economy more widely, we think monetary policy would be best staying as accommodative as possible.
Yeah, and on inflation, Mark Carney did give a rather upbeat sort of speech to Parliament last week in which he said their focus was sort of switching a little bit away from Brexit and towards what a central bank should be focusing on, which is inflation. What sort of inflation will they be dealing with this year, given that we've actually seen sterling have its best start to the year ever, actually, in January?
Yeah, and the fact that inflation has been accelerating, at least until recently, and is above their target, they have said, and we would fully agree, is down to the weakness of sterling over the referendum and the months before and after that. So as we sort of get further away from that fall in sterling, we're starting to see inflation reflect fundamentals. Now, time will tell how strong or weak domestically generated inflation pressures are. In our view, not least because of the weakness of the consumer I was just talking about, there isn't anything to worry about in terms of domestically generated inflation. And as time goes on, assuming sterling stays where it is or even strengthens further, you should see inflation come down quite swiftly towards their target. And as the weakness or the previous volatility of sterling falls out of the year-on-year calculations, it should become much clearer what they're dealing with, I think.
Yeah. When we got the hike in November, it was sort of seen as a dovish hike, and we saw that reaction in the markets. On the day, we saw sterling drop more than 1%. We saw gilt yields fall some 8 basis points. Today, are the risks more to the downside for sterling and gilt yields?
They probably are on the day, in truth. I think, with the moves we saw in January, it wasn't just the bond market sell-off. There was a lot of optimism around about the Eurozone, about tax cuts in the US, and this sort of general feeling of central banks starting to move more quickly towards policy normalisation. And I think that the UK front end and perhaps sterling have been anticipating that. So if they want to give a more balanced tone, then there is perhaps scope for sterling to just sort of moderate a little bit today. Front end yields just to sort of settle down around these levels or even come off a little. And then, as I said, we're back to data watching and seeing how Brexit negotiations go.